Thanks, Tando. As an introduction to the session, I thought it might be useful to remind the attendees of the views we expressed in mid-May 2021. At the time, we held the view that the global economic recovery was set to continue and was underpinned by low interest rates, fiscal stimulus measures, and the gradual reopening of most sectors as the vaccine rollout throughout the world gathered momentum. These views have largely materialized and have contributed to our portfolio returns over the last year. Our overweight positions to local and global equity during this period, in particular, has been a strong driver to both absolute and relative returns. A lot of the global macro environment has changed in the last 9 months or so. Some of the more significant changes include: 1. Rising inflation and as a result thereof, tighter monetary policy conditions. 2. Economic growth is starting to moderate, although still positive, on the back of higher interest rates and continued supply chain disruptions. And 3. The war in Ukraine is proving to be an impediment to both global growth and investor sentiment. This, however, has not changed our position in any meaningful way, and I will now unpack our current position. I think the most important takeaway from our position is that we have many levers or sources of returns built into our portfolios. This is and has been a fundamental feature of our portfolios during the better part of 25 years. Our portfolios are always globally diversified across asset classes and strategies, given that we place equal emphasis on both the risk and return characteristics of the portfolios. I will now discuss both our asset class and strategy allocation position. From an asset allocation perspective, our preferred growth asset classes are still local and global equity. Our view is that there is still pockets of value in both local and global equity markets. Even though we are not expecting the type of returns we saw since March 2020, we still think that from a valuation and macroeconomic perspective, equity should provide decent returns over the next 12 to 18 months. We are also quite positive on South African bonds. We think that current yields of 9 to 11%, depending on the duration, are very attractive and provide investors with real returns ranging from 4 to 6%. We have a similar view on South African inflation-linked bonds, as inflation-linked bonds provide great inflation protection in the current CPI environment. We are still cautious about the South African property sector and retain an underweight position to this asset class. We are particularly concerned about the office sector, where vacancy rates are in the upper teens in certain regions. We therefore prefer to spend our risk budget on SA equities and South African bonds. We are neutral on global property. The forward-looking returns have improved considerably in recent months and are looking to reduce our underweight position to this asset class. Our least attractive asset class from a return perspective is still global bonds. From a valuation perspective, global bonds are expensive, and rising interest rates across the developed world offer very little margin of safety. We are, however, closely monitoring the rates for a better entry point. So to summarize, our portfolios have the appropriate allocation to both growth and income-producing asset classes, and we are marginally overweight to both local and global equity. Before I move on to the strategy allocation update, I think I'll provide a quick update on our thinking on the increased offshore allowance. So we support the increased offshore exposure, as this allows us to incorporate a greater investment opportunity set and prospect of greater diversification benefits into our portfolios. However, we have approached this relaxation with rigor and in the context of our outcomes-based investment philosophy, which puts the investment goals at the forefront. As a result, we will systematically be increasing our exposures across all portfolios. Importantly, we won't increase all portfolios' offshore exposure equally. Based on our assessment, we anticipate that over time, the offshore exposure in the portfolios will typically range between 30 and 40% from a strategic perspective. But we will increase this allocation gradually depending on market valuations and the investment climate. So with regards to the strategy allocation, it's a similar theme of appropriate diversification given market volatility and market valuations. Let's take a closer look at our SA equity positioning. While there are many positive factors that support the view for equity, we are mindful of the increased volatility and there are concerns around global growth and the tighter monetary conditions in parts of the developed world. We are also acutely aware of the risks stemming from global supply chain disruptions and the effect this could have on local equity counters. We are also aware of the South African macro environment and the headwinds we need to overcome. To navigate through this, we believe it is prudent to continue to have a well-balanced and diversified equity portfolio with exposures to the dominant equity styles, which include value, momentum, growth, and quality. This style diversification is also a hallmark of our investment philosophy and is a function of our fundamental and risk-based mindset. We believe this diversified strategy is not only sensible given our outlook, but will also continue to provide our clients with a smoother return profile in the event of any market shocks. To illustrate the well-balanced nature of our current equity positioning, we maintain a healthy exposure to resource shares, defensive rand hedge industrials, which include the likes of British American Tobacco, and we also have a decent allocation to SA-focused companies like banks, retailers, healthcare, and a number of attractively priced small and medium-sized companies. The resource allocation is geared to the cyclical global economic recovery. The defensive high-quality rand hedge exposure should act as a shock absorber in the event of protracted market volatility, and the exposure to the local-orientated companies is a function of the compelling valuations and decent upside over a 3 to 5 year period. The global equity component is equally diversified across growth, momentum, value, and quality strategies. The portfolio currently is tilted towards quality or defensive companies, the type of shares Laura spoke about earlier. We also have a decent allocation to value strategies. These include sectors like the financial and energy sectors, and we also have a decent allocation to growth strategies, which includes the likes of US tech companies like Apple, Amazon, and Microsoft. The portfolio also has an allocation to emerging markets, which provides further diversification benefits and is also an additional source of returns. In addition to the strategy diversification, the portfolio is also diversified across regions and sectors. If we look at the bond building block, the current positioning consists of medium to long duration nominal bonds, given the steepness of the yield curve. What we mean by that is that investors are being adequately rewarded for the duration risk of holding longer dated bonds. As mentioned earlier, there is also a healthy chunk of inflation-linked bonds in the bond portfolio. The local and global property is diversified across retail, office, industrial, and logistics sectors. However, regional diversification is somewhat less than global equity. In addition to this, we also have exposure to selected strategies that are uncorrelated to traditional asset classes. Examples of these include private equity, allocation to hedge fund of funds, as well as to infrastructure and renewable energy projects. To conclude, the returns from the portfolio since March 2020 reflect the combination of our robust investment process and strength of the investment team. Our portfolios are well diversified, and we are confident that our solutions will meet their objectives over their respective investment horizons. Our outcome-based investing philosophy, underpinned by our rigorous risk management approach, provides a robust mechanism for managing our portfolios prudently. The investment landscape is a continually evolving, exciting, and unexpected environment, and we have learned over many years the value of sensible diversification and a robust approach to inform investment decision-making and portfolio positioning. We are comfortable with the positioning of the portfolios within the current geopolitical context and believe it is well positioned to navigate this environment. We continually assess and position the portfolios based on how local and global factors develop within the framework of our approach.